Hello and welcome to yet another powerful session where we are going to learn about some powerful financial ratios. Now you must be thinking, Vivek, why are these financial ratios important and why these are required in our financial journey? But you think about it, you are watching a cricket match and you have two players. One person has made 50 runs and other person who is a batsman, he has also made 50 runs. Now, can you say both of the batsmen are equal unless you tell what is the run rate they've made? Like one person might have made a run rate of 6 runs per over and other batsman might have made 10, runs per over. Now, you will obviously say that although the runs are same, the person with a higher run rate is a better batsman, right? So this is where, run rate is a ratio, and that same principle applies when you come into the world of investing, where all these things help you to compare between different companies and gives you the perspective how they are doing versus other players. So let's straight away jump into it. I have some special, ratios which I'll show you live practically in front of you, and let's dive into this one. Awesome. So first we'll understand why and what about the ratio analysis as usual. So if you think about the concepts, there are three important things because of which the ratio analysis is super critical. The first thing, you need to understand the business model and sector of any particular investment which you are looking at. So that is where the ratio analysis gives you that power and understanding to apply all these things into your overall analysis. The second thing, as I explained the batsman example, which company is better, right? You need to know that. And third, finding the next big winner, because not each company which you are analyzing will grow in future and it will make money for you. And that is where the ratio analysis will give you actual trend, how a company is performing and how well it is going in the journey of their overall financial acumen, and how they are actually going in the business model, how they are implementing the entire system. Okay, so that is where it is going to be super critical. Now, what I'll be doing you and sharing with all of you is some very, very simple, powerful ratios, and we'll do some analysis together, how you can use this effectively. And if you master these powerful ratios, it will take you to the next level. Okay, so let's jump in, and I'll share the screen again and show you what are the types of ratio. Okay, so there are 5 different types of ratio which you need to understand. First is activity ratio. Okay, so first you need to understand what are the kind of activity company is doing. And there are some crazy stuff kind of ratios out there, right? And you will say like, Vivek, what is this? Like, these are super complicating looking ratios, right? If you see inventory turnover ratio, payable turnover ratio, all these are super crazy ratios to start with. And it might look Greek to all of you sometimes, right? That what's happening, like too difficult names, like heart attack kind of situation. And same way, there are profitability ratios, gross profit margin, operating profit margin, net profit margin, return on capital employed. Then we have liquidity and solvency ratios, debt equity ratios, leverage ratios, current ratios, quick ratios, interest coverage ratio, and then you have valuation ratios. Price earnings, price to book, price to cash flow, EV to EBITDA, and market cap to sales. And you will be like, Vivek, itne sare ratios padhne hai ye video mein. That is not the case. So I'll simplify all these different ratios and I'll tell you what exact ratios you need to use. And then we have Excel template also, right? So if you have not yet downloaded, I would highly recommend to download my Excel template, because I'll show you some of the key ratios. You can automatically, get it from there. Let me see if I can bring that Excel link up, and I'll also probably share it on the YouTube once this video is done, right? So I'll share it in the comment section below, and you can check it out later also. So I'll tell you about key ratios which you need to focus on. Not each and every ratios you need to focus on. Let me share the screen with you and let's go step by step. If you are all ready for this, just type a thumbs up in the comment box. Okay, so just hit the thumbs up so that I know you are all ready. Okay. So I need to see at least 30 to 40 thumbs up if you are all set and ready for this. Okay. So let's get started and dissect this entire piece of ratio analysis. We'll have some practical examples so that you can understand it very, very simple way. So this is a, practical example. Now imagine a shop which I call Lalaji's shop, and there is a, I generally like to show this character. So inside my community, when I've done multiple simplification of different modules, I have a character called Rocking Ranjita. So let's take that Rocking Ranjita character itself, and she is like selling bhel puri and vada pav and all that. And she sends his assistant Chotu to buy from Lalaji's shop. Okay, so he goes there, he gets all the raw material. Now Chotu forgot to, take money with him. So what he does is he says Lalaji that, okay, I'll pay you later. Okay, and he gets the raw material with him. Now what happens here are two things. If you think about it, there is one piece where, there is accounts payable that is getting created. If you see this part, there is accounts payable which gets created. Let me see if I can give a pointer or something. Yeah, so let me just do a laser pointer so that all of you can see. So if you see, this is a accounts payable. So they have to pay Lalaji some amount, right? They have got it on credit. And you book inventory on the balance sheet. This is very, very simple concept. Now that is where a very powerful ratio comes into the play, which is called receivable turnover ratio. That aapne sales kitna kiya, like Lalaji will see that, okay, I made a sale of 100 rupees, but then how much is my average receivable in that period, right? So if I did, sales of say 100 rupees and I have 20 rupees of receivable in that period, that means, I have 5x kind of receivable turnover ratio. Okay, so whatever 1 rupee I'm giving as a credit, I'm getting 5 rupees as a sales. Okay, and if you reduce it and make it inverse, you get something called as days sales outstanding. Okay, that how many days on an average my sales is outstanding. So if 20% of your sales at any point of time is receivable in a year, basically 20% of your year is a sales outstanding, right? So 365 days will be denominator and your numerator will be number of days. So that is where, the more sales outstanding, it will signify low bargaining power. So basically what we try to understand is a big picture, that what are the competitive advantages and what are the competitive forces that are helping any particular company, right? So the more this outstanding goes, the less efficient is generally the company, and you have to compare. It's not like apple to apple. You have to compare each of these companies, and the lesser it is basically good, efficient way of collecting the money. Okay, so hope this particular concept is super clear. So that is where the first ratio is the receivables day that you should understand. Let's go to the next one. Okay, are you ready for the next one? Just type ready in the comment box. All right, so let's go to the next one. And this is called total asset turnover ratio. Now, what is total asset turnover ratio? Total asset turnover ratio tells you, like, whatever asset you have, if you have a factory or you have an industry or you have a laptop, how much sales you are able to generate from that on an average, right? So if I have a laptop, say this MacBook costed me say 2 lakh rupees, and if I am able to generate say 10 lakh rupees of revenue by doing whatever in a year, then it is like a 5x of turnover, right? So whatever asset I had, I'm turning it over 5 times of my asset value. Right, so for capital intensive business like cement plant and all those things, you will have lesser asset turnover ratio. And for asset light businesses where you don't need too much of fixed asset, you will have higher asset turnover ratio. So this ratio will help you to understand whether the business you are investing is a capital intensive business or a capital light business, and how fast you are able to monetize or squeeze your assets. And this will also be helpful when you are comparing your industry. Like between two companies, which company is able to turn the asset much faster? Are you all able to get it? Just type got it in the comment box, okay? So this is what is a second powerful ratio after the receivables day is called asset turnover ratio. And there is one more version of it which is called net fixed asset turnover ratio, where you just do net fixed asset apart from your depreciation which is there. Okay, but we are not going too technical. Let's keep it simple. Okay, so let me just recap. The first ratio which we learned was receivables ratio or receivable days, and the second ratio which we are learning is total asset turnover ratio. Okay, now let's come to the third ratio which is called operating profit margin. Okay, and this is like one of the most important factor if you want to know the competitive advantage. Now what is operating profit margin? So if you think about it, as soon as you buy some product, right, they get revenue. Like say for example, in Rocking Ranjita's case, she will get revenue when somebody buys their product and gives them money. Even if it is like udhar or credit, still they get revenue, right? Then you have cost of goods sold, where whatever material like raw material, aloo and all those things, they will remove. So that is cost of goods sold. You get gross profit. So there is one more ratio which calculates gross profit margin, that on a first level itself, how much money you are making. So if you divide gross profit by revenue, it will give you gross profit margin. And all these ratios which I mentioned, right, all these profitability ratios, generally gross profit margin, operating profit margin, net profit margin has a denominator as a revenue. Okay, so anything you want to divide it by revenue. So that is gross profit margin. Now you have all the operating expenses. You might have electricity expenses, rent expenses, all those things you remove it, and you also remove depreciation of your fixed asset. And that is where you get to something called as operating profit. And that is where it is very important to calculate ke bhai bacha kya, what percentage I am making after paying all the cost. That is what is operating profit margin. So say for example, you earn 100 rupees as a revenue and 80 rupees went into your raw material, your operating expenses and depreciation. The 20 rupees margin which you are maintaining, that is what you are getting. And of course there is government which will take tax, there is interest if you have taken debt, that is all there. But at a business level, you are still having good margin. That will give an idea that if you are able to command a big margin, you are having some kind of competitive advantage. So the more the margin, the better it is. And what I do to analyze all these ratios is simply, if you think about, just give me a second. So here I basically download my usual Excel. And by now you might be knowing if you are watching my video. This Excel you can also download here. Let me give the link to all of you. You can download this Excel here and then you can start using this. So ultimately this will give Excel like this. And if you go to the income statement, all these margins which I'm talking about, it is already calculated in the sheet. How many of you found this powerful? Just type wow in the comment box. So you don't need to do all the hard work. What I will tell you is the application part of all these ratios, right? So basically, if there is an operating profit margin, first of all, you see the trend of a company, like whether it is going up or going down. If it is consistently going up, that means company is doing something special at an operating level. Then you see net profit margin, same thing, net income by revenue. And you see what is the trend over here. Okay. And then you relate back to how to basically connect the dots. Like I have covered a video, like just recently I created a video of how to read annual report. And all these things in the trend, you actually try to find out in the annual report that what is the reason behind it. And there is one more video which I have created is fundamental analysis of stocks using Excel screener. Okay, so you can connect both the things, but the idea should be first measure the trend at a company level. And second, you compare different companies in terms of trend. Like if say for example, Astral, they are doing on an average say 17% operating profit margin and some other companies say doing 25%. Then you try to find out what different that company is doing which Astral is not doing. And otherwise also there might be a company which is at 10% operating margin and exactly into the same product. Then you try to compare what Astral is doing so special that the other company is not able to make so much of operating profit margin. And that is where the magic of application of this entire ratio analysis formula is really critical. Okay, so this is the formula of operating profit margin, and I've given some pointers also, like sometimes you need to remove non-operating items and all those cleanups, but this is what it will give. And it is very important ratio which gives idea about competitive advantage and cyclicity of the company. Why cyclicity? So say for example, you download a sugar company, the operating margin will not be like stable like this. It will be like 10% sometimes, then 20%, then 5%, then minus 2% also sometime if they are making loss at a EBITDA level, right? So that is where you also know the cyclicity of the company and the business model of the company. Rather than, directly jumping in and putting so much effort and reading 10 years annual report, if you just glance through these key ratios, it will give you a super important idea about what you are doing. Now, next thing which is very powerful is to understand the return on capital employed. Like say for example, I tell you put 1 lakh rupees and you are going to get 6% of net income. Like you get only 6,000 rupees as a profit. and I tell you that the FD rate is 8%. So you get 8,000 rupees by putting money into FD. Does it make sense to do that business if it is giving a return on capital employed of just say 6%? So that is why understanding the return on capital employed is very important. And it's very simple. You have EBIT on the numerator and capital employed. It could be debt or equity or the combination of both, how much you are using. And finally, as an owner, whatever you put in, that is equity, and on the top there is net income. Like on an aggregate basis, what you are making. And by the way, how many of you want a amazing gift? Like I'll be giving a special gift to all of you. Whatever PPT I'm showing, I'll be giving that PPT to all of you. How many of you are ready for it? So during the video, I'll be sharing this. But if you are wanting this PPT, just type me in the comment box. Okay, just type me if you want this PPT which I'm sharing, because this is what is a cheat sheet to your entire analysis. If you master these few ratios, it will make you super powerful. Okay, so I'll be sharing that link of this cheat sheet anytime during the video. Just stay focused and I'll be sharing it with you, right? So let me again share the screen and let's come to the ROE. So ROE is similar, but it sees on an owner level, like at an equity holder level, whatever money you are putting, how much money you are making. Okay, so net income divided by average total equity is what this ratio gives you. So if the ROE is higher, you know that the profitability of the company is higher and you are actually beating the cost of capital. Now, what is cost of capital and everything? You can go and watch my Excel video. I've covered that in detail. I've also showed this before. You just go and check it out over here. And even all the things on how to use this Excel which I showed you, it is also over there, right? So you can separately go there. But that is where the ROC and ROE equation is super useful. Okay. Now the next thing which you need to do is again going back to the Excel, and you go to balance sheet. And in balance sheet, I have covered all these ratios which I have talked about so far. Okay, so you have net fixed asset turnover ratio, you have receivable days ratio, you have inventory turnover ratio, you have return on average equity ratio, and you have return on capital employed ratio. So you just see the trend, like whether it is, at least more than 15%. Are they also making some decent money? Okay, and same way, you also see the return on equity, like whether they are doing decent at a shareholder level. Now, some companies might do excellent ROE, but they might be taking too much of debt. And that is where the leverage ratio, which is called debt to equity ratio, is very important. So it simply says what is the debt you are taking versus the money which you have put in as a shareholder. Okay, so if the debt to equity ratio is generally, if it is more than 2, it is really a dangerous sign. Again, it depends upon sector to sector, and that is where this is also incorporated in your Excel sheet. So if you see debt to equity of Astral is hardly anything. It is like almost debt-free company. And if you find companies like that, you want to make most of it. Okay. Next, if you go about, we have one more ratio which is called interest coverage ratio. Say for example, you are earning, say, after all the cost and everything, after your salary, the tax deduction and everything, you are say making 1 lakh rupees, and you have EMI where the interest component is 30,000 rupees. So do you have good buffer? Like even if your salary fluctuate, can you still pay the interest? The answer is yes, right? Because it's 30,000 and almost 3x plus you have buffer. But what if somebody is just left with say 30,000 rupees after the salary, and they have to pay 30,000 as an interest? So your interest coverage is barely 1 times. So this is where it gives the idea whether company is not too much leverage and whether the profit which they are making will be able to service the interest cost at least. So the more the number of this multiple, the better it is. Ideally 3x is minimum what I look personally. Okay, and that ratio is also covered in our Excel sheet. So you can go and check it out. In the cash flow, all these ratio is there, and even in the ratio analysis sheet, all these ratios I've calculated. Okay, so here you will find interest coverage ratio, and if you see Astral, it is like humongous and it is like very safe company from that perspective. Then we have a important powerful ratio which is called Dupont Analysis. So we basically break it down, the ROE, into 3 components. So if you see, the numerator is net income and denominator is total shareholders equity. So we break it down. Basically it is this net income and then this shareholder equity. So we are just multiplying numerator and denominator with the same thing. So if you see this orange, we are multiplied by 1. If you see this revenue, we are just multiplied by 1. But it gives us 3 different ratios, like net profit margin, how much ROE is getting contributed by net profit margin. What does that tell you? That if there is a business which is premium, like if you buy a Gucci bag, what do you think their margins will be? It will be like super normal margins, right? So if you are selling a premium product, your ROE will come majorly from net profit margin. If you are selling commodity, if you are selling salt, what will be your margin? Like 0.5%, 1%. But there you are probably playing volume game, right? So whether a business is commoditized or more premium side, you will get the idea from net profit margin. Now asset turnover ratio will tell you whether you have a capital intensive business or you have capital light business, right? So if you have a business like ThyroCare, you do testing every single second and your machine is running like 24 hours and it doesn't cost too much compared to the volume of samples you get to test it. So that is like more of a capital light model versus the cement industry. So you know what is the driver of your ROE. And then finally, if a company is having too much of leverage and just because they are having too much of debt, their ROE is getting much more bigger, then you know that this company is just taking too much risk to make that profits happen, right? So that is why this Dupont analysis is very, very powerful. And again, in the Excel, I've covered this 5-stage Dupont analysis. You can go through it and it's a super powerful, thing. And within my community, we actually have a dedicated video on Dupont analysis. Whenever you join my community, you can go and watch it. And this is like an entire one sheet on Dupont analysis. And finally, all these ratios, you can actually track it through the graph and you can create your own graphs. It is like a very flexible Excel in that way. So you can create your own graphs and see the trend, where it is going and how the ratios are performing. And you can get powerful insights from understanding all these things. And finally, the valuation ratios. A lot of people keep talking about what is P multiple and how does it calculate it. It's a very simple ratio. You see price of that company's shares and what is the earnings per share. Okay, so price per share and earnings per share gives you a P ratio. It gets calculated in multiple ways. You can get it on the past year, you can get it on past 12 months, or you can get it on a forward earnings also, like 1 year forward, how the earnings looks like. Or you do it on a proxy of it, like market cap of that company divided by net income. So this is one of the most used ratio, which is called P ratio, used in multiple valuation techniques. But you have to be careful with this metric, because sometimes it is misleading if you don't factor past or future growth factors. Sometimes some company is very rosy in the past, and you might feel the P ratio is very low and you might end up buying it, but the future is not great. Imagine you are buying a Kodak share and you might feel, oh, the history is so good, but then the future is not that good. And sometimes the company is going into the next level trajectory and it might be having good future, but you might just see the mirror and see, oh, the P ratio looks too high because my market is actually factoring, higher earnings growth for the future, and you might end up buying not buying such beautiful companies also, which are going in future. So understand how this is used and properly dissect it, and this can make a lot of money for you. And finally, let's come to the gift which I promised to all of you. So the gift for this session is this mind map. If you want to download this mind map, simply go to this link, technofunda.co/ratios, and you'll be able to find this link to download this entire PowerPoint which I shared with you, right? It's a beautifully made PowerPoint, and I'm sure it will help you in your investing journey. Let me also highlight it on the screen so that you can download it. Okay, so just go and check it out and let me know how you found this video. And this video, I did it based on suggestion of few of the viewers last time. So if you want to watch a specific content, just type in the comment below, what do you think about this particular video and which kind of video you want to watch it in the future. Some of you are also requesting in Hindi. I'm sure, sometimes I'll also create similar video on Hindi, but hope this entire session was super useful. And I'm also nurturing a community of TechnoFunda investors. We have, amazing community where we learn together. We do a lot of stuff, hackathon and all those things. If you want to join my community, you are always welcome. Just check out the link in the description below and you can always join my community as well. Yeah. So thank you so much for watching. Take care and Jai Hind.